Over the past few years, a quiet milestone passed with almost no public reaction. Total debt across the largest developed economies moved beyond $100 trillion. That number is so large, it becomes abstract. It is bigger than annual global output, bigger than the combined savings of most households. And yet, daily life continued. Markets opened, paychecks arrived, retirement accounts fluctuated as usual. That silence is the first signal. Because debt at this scale is not just a statistic. It is the foundation of the modern financial system. Governments borrow to fund budgets. Corporations borrow to expand and buy back shares. Households borrow to buy homes, cars, and education. Banks borrow short-term and lend long-term. Pensions rely on bonds. Insurance companies depend on predictable yields. The entire structure is interconnected. Debt is not inherently reckless. In fact, it has been one of the most powerful tools for growth. Borrowing allows societies to pull future productivity into the present. Roads are built before tax revenue arrives. Companies invest before profits materialize. Families buy homes decades before they can pay in cash. When managed carefully, leverage accelerates progress. For nearly 40 years, the system had a powerful tailwind, falling interest rates. After the inflation shocks of the 1970s, central banks steadily brought rates down. Each economic slowdown was met with easier policy. Each crisis brought another cut. The cost of borrowing declined decade after decade. This created a simple but powerful dynamic. As rates fell, existing debt became easier to service. Governments refinanced at lower yields. Corporations issued new bonds at cheaper costs. Homeowners refinanced mortgages and lowered monthly payments. Asset prices rose because future cash flows were discounted at lower rates. The system expanded smoothly because the price of money kept dropping. In that environment, higher debt levels did not feel dangerous. They felt manageable. If interest costs decline while income grows, leverage appears sustainable. Debt-to-GDP ratios climb, but servicing costs remain stable. Investors gain confidence. Policymakers gain flexibility. Risk premiums compress. Financial markets begin to assume that liquidity will always return when needed. Over time, low rates became normal. Zero interest rate policy stopped sounding extreme. Bond yields near 1% felt acceptable. Entire generations of investors built their models on the assumption that inflation would stay low and central banks would step in during stress. But the foundation of that world was simple. Money was cheap. Now, that foundation has shifted. Inflation returned in a way few expected. Supply shocks, fiscal stimulus, and tight labor markets combined to push prices higher across developed economies. Central banks responded the only way they could, by raising interest rates rapidly. In some cases, at the fastest pace in modern history. This is the structural break. When rates rise in a system carrying moderate debt, the impact is manageable. When rates rise in a system saturated with debt, the effects compound. Every percentage point increase translates into billions in additional servicing costs. Every refinancing cycle becomes more expensive. Every maturity date becomes a pressure point. And here is the critical detail. Much of this debt was issued when rates were near historic lows. Governments locked in short and medium-term maturities, assuming cheap refinancing would continue. Corporations borrowed aggressively to optimize balance sheets. Households stretched to afford rising home prices. That was rational behavior under the old rules. But the rules have changed. Today, new borrowing costs are several multiples higher than they were just a few years ago. As existing debt rolls over, it must be refinanced at these higher levels. The adjustment does not happen all at once. It unfolds gradually, bond by bond, mortgage by mortgage, budget cycle by budget cycle. That is why the risk feels invisible. There is no dramatic breaking point in the headlines. No single announcement that declares a crisis. Instead, there is a steady increase in interest expenses inside government budgets. A slow compression of corporate margins. A subtle tightening of credit conditions for households. The pressure builds quietly beneath the surface. The core question is not whether debt is good or bad. The real question is this: What happens when the cost of money rises in a world built on the assumption that it would stay cheap? Because if borrowing no longer becomes easier over time, then growth models, fiscal plans, and asset valuations must all adjust. And if adjustment is slow, it can be absorbed. If it is fast, the system feels strained. This is not about collapse tomorrow. It is about structural stress accumulating inside balance sheets that were designed for a different rate environment. And to understand why this shift matters historically, we need to examine what just broke and why bond markets are sending a signal that few are discussing openly. To understand why this shift matters historically, we need to look at the rule that quietly governed markets for 4 decades. From the early 1980s onward, interest rates mostly moved in one direction, down. After inflation peaked in that era, central banks pushed rates lower over time. Each recession was met with easier policy. Each financial shock brought new liquidity. Over years and then decades, borrowing became cheaper and more accessible. That downward trend shaped behavior everywhere. Governments learned they could run larger deficits because refinancing costs kept falling. Corporations increased leverage because issuing debt was cheaper than issuing equity. Private equity models thrived on inexpensive credit. Households stretched into larger homes because mortgage rates steadily declined. Asset prices rose as discount rates fell. Bonds delivered capital gains for years as yields compressed. The underlying assumption was simple. Tomorrow's money would cost less than today's. That assumption became embedded in financial models, pension forecasts, real estate valuations, and government budgets. Even risk management frameworks were built on it. If growth slowed, central banks would cut rates. If markets stumbled, liquidity would expand. The system had a pressure valve, but that valve depended on one condition. Inflation had to remain contained. When inflation returned, the entire framework shifted. The recent surge in consumer prices across advanced economies forced central banks to reverse course. Instead of easing into weakness, they tightened into strength. Policy rates rose rapidly. Balance sheets stopped expanding and, in some cases, began shrinking. Liquidity was no longer abundant. This is the rule break. In a high-debt system, rising rates are not just a policy adjustment, they are a structural shock. Debt servicing costs begin to climb. Governments that issued short and medium-term bonds at low yields must now refinance at higher ones. Corporations with variable rate loans see interest expenses rise immediately. Households renewing mortgages face higher monthly payments. At first, the changes seem manageable. Budgets adjust slightly. Companies trim spending. Consumers slow discretionary purchases. But over time, the math compounds. When the interest rate on debt rises above the growth rate of the economy, the burden increases relative to income. If an economy grows at 3% but its borrowing costs move toward 5 or 6%, the gap must be financed somehow. Either deficits widen, spending is reduced, or new debt is issued to service old debt. This is the key signal. In several advanced economies, interest expenses are rising faster than tax revenues and faster than GDP. That dynamic does not resolve itself automatically. History shows that when debt growth outpaces economic output for too long, systems adjust. The adjustment can take different forms. Sometimes inflation erodes the real value of liabilities. Sometimes currencies weaken. Sometimes governments restructure obligations. In other cases, financial repression keeps interest rates below inflation to manage the burden quietly. The outcome varies. The pressure does not. Bond markets tend to recognize this pressure before equity markets do. Stocks reflect optimism about earnings and innovation. Bonds reflect trust in repayment over time. When investors demand higher yields to hold sovereign debt, they are signaling increased risk or reduced confidence in long-term stability. Yield curves have behaved unusually in recent years. Short-term rates surged as central banks tightened, while long-term yields fluctuated between growth fears and fiscal concerns. At times, curves inverted deeply, historically associated with economic slowdowns. At other times, long yields rose sharply as investors priced in higher deficits and persistent inflation. These distortions are not random. They reflect uncertainty about the future path of growth, inflation, and fiscal credibility. Sovereign credit ratings have also come under scrutiny. Even small downgrades or warnings can shift borrowing costs when debt levels are high. A 1% increase in average funding costs can translate into tens of billions in additional annual interest payments for large economies. Refinancing risk becomes central. Governments do not repay debt in one lump sum. They roll it over continuously. Each year, a portion matures and must be reissued. When yields are higher, that rollover becomes more expensive. The larger the debt stock, the more sensitive the system is to rate changes. For years, the assumption was that refinancing would always be easier. Now, it is becoming more costly. This does not guarantee a crisis. It does mean the financial playbook of the last 20 years may no longer apply. Easy liquidity cannot be assumed. Declining yields are no longer a certainty. Policy flexibility is narrower when inflation remains a concern. The quiet era of ever-cheaper money-shaped decisions across the global economy. Its reversal reshapes incentives just as broadly. And when incentives change, power shifts. Because in a world where borrowing is no longer effortlessly cheap, the question is no longer just about debt levels. It becomes about who holds real leverage and who ultimately controls the assets that others must depend on. Because in a world where borrowing is no longer effortlessly cheap, leverage changes hands. For decades, the largest economies held a quiet advantage. They issued the reserve currencies. They controlled deep capital markets. Their government bonds were treated as the safest collateral in the global system. When they borrowed, the world lent. But when debt levels become extreme and interest costs rise, even reserve issuers face constraints. Governments need steady demand for their bonds. Central banks need global confidence in their currencies. Large nations that rely on foreign buyers must maintain trust, or borrowing costs climb further. Debt, in this sense, is not just a balance sheet item. It is a geopolitical instrument. When a country runs persistent deficits, it depends on someone else to finance them. That someone can be domestic savers, pension funds, banks, or foreign governments. If domestic savings are insufficient, foreign capital fills the gap. Over time, that creates a web of mutual dependence. Now widen the lens beyond finance. Every modern economy depends on physical supply chains. Energy powers factories and transportation. Rare earth minerals enable electronics and defense systems. Agricultural exports feed populations. Strategic shipping routes connect producers and consumers. These are not abstract flows. They are tangible assets controlled by specific nations and regions. In a low-debt world, supply chain disruptions are painful but manageable. In a high-debt world, they are destabilizing. Consider energy. If a major importer faces a sudden spike in oil or natural gas prices, its trade deficit widens. Government subsidies may increase to shield households. Inflation rises, forcing tighter monetary policy. Higher rates increase debt servicing costs. A single external shock ripples directly into fiscal strain. The same applies to food and industrial inputs. Countries that control fertilizer, grain exports, semiconductors, or critical minerals gain negotiating strength when shortages emerge. In a fragile debt environment, that strength amplifies. The deeper battle, then, is not between stock market bulls and bears. It is between debt issuers and real asset producers. Debt issuers promise future repayment in currency. Real asset producers control the materials the world needs today. When financial conditions tighten, tangible resources often gain relative leverage. Credit can be created digitally. Energy and minerals cannot. This is why supply chains matter in a debt story. When trust in fiscal sustainability weakens, capital begins to move differently. Investors look for resilience. Countries with trade surpluses and strong commodity bases may experience currency stability. Nations heavily dependent on external financing may face pressure. We have already seen subtle shifts. Some emerging economies are settling trade in alternative currencies. Bilateral agreements are expanding. Strategic stockpiles of energy and food are being increased. Industrial policy is returning as governments seek to secure domestic production capacity. These are not random policy moves. They reflect a world reassessing vulnerability. Central banks, 2. Have adjusted behavior. Over the past decade, many have increased gold reserves and diversified away from concentrated holdings. Gold does not carry counterparty risk. It is not tied to another nation's fiscal policy. In periods of systemic strain, it functions as a neutral reserve asset. Reserve diversification sends a signal. It suggests that monetary authorities are preparing for greater volatility in currency relationships, not collapse, but friction. When debt is manageable, trust is abundant. Bonds trade smoothly. Currencies remain stable. Supply chains operate on efficiency rather than redundancy. But when debt burdens grow heavy and refinancing becomes more expensive, efficiency gives way to security. Redundancy costs more. Strategic reshoring raises prices. Military spending increases to protect trade routes. Each of these choices feeds back into fiscal balances. Small disruptions that once seemed temporary can now trigger larger consequences. A shipping bottleneck delays goods, raises prices, pressures central banks, and tightens financial conditions. A trade dispute reduces export revenues, weakens a currency, and complicates debt servicing. The system becomes more sensitive. This is the quiet power transition embedded in the debt trap. It is not necessarily a dramatic confrontation. It is a gradual shift in leverage from pure financial dominance toward control of real assets and production capacity. The countries that can produce energy, food, and critical materials internally possess insulation. Those that rely heavily on imported essentials while carrying large debt loads face more complex trade-offs. None of this guarantees instability, but it does change the negotiation dynamics between nations. And once geopolitics enters the equation, money itself begins to change character. Because when trust and debt intersects with competition over resources, currencies stop being neutral measuring tools. They become strategic instruments. To understand what that means for savings, purchasing power, and long-term stability, we now need to examine the monetary layer beneath this power shift. To understand what that means for savings, purchasing power, and long-term stability, we now need to examine the monetary layer beneath this power shift. At its core, debt is a promise denominated in currency. When governments borrow, they commit to repay in their own money. That gives policymakers flexibility. Unlike households, sovereign issuers of reserve currencies cannot run out of their own units, but they can change the value of those units over time. When debt burdens grow large relative to economic output, the menu of options narrows. Governments can raise taxes. That increases revenue but risks slowing growth. They can cut spending. That improves fiscal balances, but often proves politically difficult. They can attempt to grow their way out of debt through productivity gains. That is ideal but uncertain. Or they can allow inflation to reduce the real value of outstanding obligations. There is also a quieter path: financial repression. Financial repression sounds technical, but the mechanism is simple. If inflation runs at 4% and government bonds yield 2%, the real return to bondholders is negative 2%. Over time, this gap erodes the real burden of debt. The borrower benefits. The lender absorbs the loss in purchasing power. This does not require dramatic policy announcements. It can happen gradually. Central banks may hold rates lower than inflation for extended periods. Regulatory frameworks may encourage banks and pension funds to hold government bonds. Capital controls can limit alternatives. The adjustment unfolds quietly within the financial system. For savers, the effect is subtle but powerful. A savings account earning 3% in a world of 5% inflation appears stable in nominal terms. The balance rises. Statements look positive, yet purchasing power declines each year. Over a decade, the difference compounds meaningfully. This is how debt can be managed without default. Currency dilution becomes a silent tool. If the money supply expands faster than real economic output, each unit represents a smaller share of total goods and services. The nominal value of assets may rise, but their real value relative to essentials can stagnate. Money, in this environment, changes character. In low-debt, low-inflation systems, currency is a stable measuring stick. Bonds serve as reliable stores of value. Long-term contracts feel predictable. Trust is anchored in institutional credibility. In high-debt systems under pressure, the measuring stick begins to shift. Investors question long-duration commitments. Demand for shorter maturities increases. Real assets, those tied to physical scarcity, gain attention. Commodities, productive land, infrastructure, and precious metals often see renewed interest during periods of monetary strain. This shift is not emotional. It is rational. If long-term bonds yield less than inflation and fiscal deficits remain elevated, holding nominal debt becomes less attractive. Capital looks for protection against purchasing power erosion. The greater the perceived gap between inflation and policy rates, the stronger this incentive becomes. Currency strength ultimately rests on confidence. If domestic and foreign investors believe a government will maintain fiscal discipline and protect real returns, demand for its currency remains solid. If that belief weakens, exchange rates adjust. A weaker currency can improve export competitiveness. It can also raise import costs and feed domestic inflation. That, in turn, complicates central bank decisions. Tighten policy to defend the currency, and debt servicing costs rise. Loosen policy to support growth, and inflation pressures build. These trade-offs define high-debt monetary environments. Importantly, none of this requires a dramatic collapse. The erosion can be incremental. Inflation runs modestly above target for years. Real yields remain slightly negative. Public debt ratios stabilize slowly, but only because purchasing power drifts downward. Savings do not vanish overnight. They adjust gradually to a new reality. This is why the threat is systemic rather than theatrical. It unfolds through budget statements, bond auctions, and policy meetings, not breaking news alerts. It expresses itself in higher grocery bills, rising insurance costs, and slower real wage growth. Over time, households begin to feel that money stretches less far than it once did. Yet bank balances may appear intact. Markets may remain open. The system continues functioning, even as underlying value shifts. The central question becomes one of credibility. Can policymakers manage debt burdens without undermining currency stability? Can they maintain trust while navigating inflation and growth constraints? For individuals, these macro dynamics translate into personal decisions, because once purchasing power becomes uncertain and real returns compress, the focus shifts from maximizing gains to preserving resilience. And that brings the story closer to home. Large debt numbers and bond market signals can feel distant, but the effects move slowly into daily life. When governments spend more on interest, that money cannot be spent elsewhere. Budgets are finite. If a rising share goes toward servicing past borrowing, less remains for infrastructure, education, healthcare, or tax relief. This process is called crowding out. It does not happen overnight. It appears gradually in budget negotiations. Projects get delayed. Maintenance is deferred. New programs face tighter scrutiny. At the same time, policymakers face pressure to maintain social benefits and public services. The tension grows as interest expenses rise faster than revenues. Taxes may increase subtly through bracket changes or reduced deductions. Fees expand. Inflation acts as a hidden levy, reducing purchasing power without a formal vote. None of these adjustments feel dramatic in isolation. Together, they shape household finances. Asset markets also respond. When interest rates remain elevated and fiscal paths look uncertain, volatility tends to increase. Equity valuations adjust to higher discount rates. Bond prices fluctuate as investors reassess inflation expectations. Credit spreads widen when lenders demand compensation for risk. For households, this can mean more uneven retirement account balances and tighter lending standards. Mortgage approvals become stricter. Auto loans cost more. Small businesses face higher financing expenses. Credit conditions do not shut down entirely, but they become more selective. To navigate this environment, it helps to use clear mental models. The first is the interest burden ratio. This measures how much of government revenue goes toward paying interest on debt. If that share rises steadily, fiscal flexibility shrinks. A country spending 10% of revenue on interest has more room than one spending 25%. Watching this ratio over time reveals structural pressure more clearly than headline deficit numbers. The second is the refinancing wall. Debt does not mature all at once. It comes due in waves. When large portions must be rolled over during periods of higher rates, interest costs can jump quickly. Even if total debt remains stable, the price of carrying it increases. Understanding when major refinancing cycles occur helps explain why stress sometimes builds suddenly after years of calm. The third is the inflation versus yield gap. This is the difference between what savings earn and how fast prices rise. If inflation averages 4% and a savings vehicle yields 2%, the real return is negative 2%. Over long horizons, that gap matters more than short-term market swings. These models do not predict crises. They frame incentives. Debt cycles unfold over years, sometimes decades. There are periods of stability, followed by adjustment phases. Policymakers respond, markets react, and new equilibriums form. Trying to time every move is less useful than understanding direction and pressure. Resilience becomes the goal. Resilience means recognizing that real returns may be lower for extended periods. It means expecting more policy experimentation. It means understanding that volatility is a feature of transition phases, not necessarily a signal of collapse. Importantly, high debt does not guarantee failure. Many economies manage elevated debt for long stretches. What matters is credibility, growth, capacity, and the balance between interest costs and income. By focusing on structural indicators rather than headlines, individuals can interpret events more calmly. A rate hike is not just a market event, it is part of a broader adjustment. A currency move reflects underlying capital flows. A bond sell-off signals changing trust. The objective is clarity, not fear. Because once we understand the mechanics, the final question becomes clearer. How might this debt cycle resolve? Will adjustment remain gradual, shaped by controlled inflation and moderate growth? Or could external shocks accelerate the timeline? To answer that, we need to consider the range of possible paths ahead. Debt cycles rarely end in a single dramatic event. More often, they evolve through phases. Pressures build, policies adapt, and outcomes emerge over time. Today, there are three broad scenarios that could shape the next chapter. The first is gradual inflationary erosion. In this path, inflation remains moderately above historical targets for several years. Central banks keep policy rates relatively contained to avoid destabilizing fiscal balances. Real interest rates hover near zero or slightly negative. Governments refinance debt steadily, accepting higher nominal costs but benefiting from inflation's slow reduction of real liabilities. Currencies may weaken incrementally, especially against scarce assets or stronger trading partners. Bondholders experience low or negative real returns, but not outright default. Growth remains modest. The system adjusts quietly. This scenario is historically common. It spreads the burden across time. Savers absorb part of the adjustment through reduced purchasing power. Governments avoid explicit restructuring. Markets remain functional, though less predictable. The second scenario is a growth surprise. Productivity gains, technological breakthroughs, or structural reforms could accelerate real economic expansion. If growth rises above interest costs, debt-to-GDP ratios stabilize or decline naturally. Tax revenues increase without higher rates. Confidence improves. Bond yields normalize relative to stronger fundamentals. This outcome requires more than stimulus. It depends on real output gains: energy, innovation, supply chain efficiency, labor participation, or new industries. Growth of this kind expands the denominator of the debt equation. While less discussed, this scenario cannot be dismissed. Economic history includes periods of unexpected productivity acceleration. When growth outpaces expectations, fiscal stress eases without dramatic policy shifts. The third scenario is fiscal shock. In this path, bond markets lose confidence more abruptly. Investors demand significantly higher yields to compensate for perceived risk. Refinancing costs spike. Currency volatility increases. Policymakers face harder trade-offs between defending the currency and stabilizing debt markets. A fiscal shock does not require default. It can manifest as rapid repricing. Governments may respond with austerity measures, emergency monetary support, or new capital controls. Adjustment becomes faster and more visible. This scenario is less gradual and more disruptive. It compresses years of pressure into shorter periods. Importantly, none of these outcomes is predetermined. Elements of each could appear in sequence. A period of gradual inflationary erosion might be followed by renewed growth. A growth attempt could falter and lead to renewed fiscal stress. Debt cycles reshape financial systems in ways rarely predicted by the majority. Before past turning points, consensus often assumed stability would continue. The transition, when it came, reflected accumulated pressures rather than a single trigger. The key message is not certainty, it is preparedness. High debt combined with higher rates narrows policy flexibility. It increases sensitivity to external shocks. It amplifies the consequences of miscalculation. At the same time, institutions remain intact. Markets function. Governments retain tools. The system is stable until the balance between credibility and cost shifts. And that balance ultimately depends on one strategic choice. If pressures intensify, will policymakers prioritize protecting bondholders through higher real yields? Or will they prioritize protecting economic growth and employment, even if that means allowing currencies to weaken over time? That tension sits at the center of the debt trap. Because if currencies absorb the adjustment, scarce reserve assets and alternative stores of value may gain relative strength. If bondholders are protected at all costs, fiscal strain may force political consequences elsewhere. The next signal will likely appear not in headlines, but in capital flows and reserve behavior. And that is where our attention turns next.